Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 8th of August. I'm Daniel Lam, your host for the podcast. Over the last 2 months, I've been studying in depth the classic chess book, My 60 Memorable Games, by Robert James Fischer, also known as Bobby Fischer, possibly the most famous world chess champion out there. The games that stuck to my mind the most were the ones where one of the players missed an initial opportunity, but when the chance arises for the second time, they do not miss. Now, one of the most pertinent questions out there amongst the high-profile risky assets is that, is this the second chance to go short the dollar yen? Now, over the last 6 weeks, the dollar yen was on its sharpest fall since November last year, when the BOJ first mentioned potential tweaking in the yield curve control policy. Since then, it nearly wiped out the entire move. Well, in a nutshell, yes, they should take this partial reversal as an opportunity to add to their long yen position. Technically speaking, the pressure on dollar yen is still out there because on the down move, it broke below the previous low at 138.74 at the start of June. And on the up move, it failed to break above the previous high at 105.07 at the end of June. So i.e., the dollar yen is on a lower low and lower high trend. That's a classic bearish pattern. Now, last week, following BOJ's tweak to the YCC policy, they followed up with unscheduled bond purchases to manage the pace of the rise in bond yields. This comes against Japan's largest ever minimum wage hike. So while the hike was still lower than those seen in other developed economies, a continued move towards higher inflation and greater policy normalization are likely to be positive for the Japanese yen. So therefore, we expect the dollar yen to maintain a bearish bias over the next 2 to 4 weeks, with key support levels at 104.9, followed by 137.30. Ultimately, on a 6 to 12 month horizon, we're expecting the dollar yen to reach 130. Now, an associated question: what is the feed into Japanese equities? Well, expectations of rising interest rates could be a valuation headwind, especially for long-duration growth sectors. However, the largest sector in MSCI Japan Index is industrials, which is nearly 1/4 of the index. And that's the reason why Japan is typically seen as a cyclically exposed market. We also expect any increase in Japan's rates to start from a very low base, likely occur at a moderate pace, and be accompanied by some inflation and nominal growth. Now, we believe that this potential shift away from a no-growth regime, along with exposure to improving growth in China, that would be positive for Japanese equities overall. Rising rates would also benefit the bank's interest income. So therefore, we do not expect the BOJ policy shift to have a material effect on Japan equities. Our overweight rationale for Japan, based on improving corporate governance, remains unchanged. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.